All right, let's talk about the mystery charts and the methodology in action. This is this week's mystery chart. This is a buy, believe it or not, in this market, huh? You can, there's the parameters down below, straight from the spreadsheet. If you want to look at these archives, you can go to davelandry.com/archives. And if you want to see the newer ones, you can go to youtube.com/Dave Landry. If you want to see them live, of course, you can go to davelandry.com/trading service. Anyway, nice little trend higher, nice little pullback to the moving average. This is what I call a Landry-like pullback. Entries here, stop is here, initial profit target is up here. Notice that you pull back to the 30 EMA after 10 bars of Landry light, and it's been in a longer term uptrend too. As you can see, going back for a long, long time, or just look at this big blue arrow. And the Landry light just counts the number of bars, obviously, above, for uptrends, the moving average, the number of lows above the moving average. You can use your favorite moving average in a TFM 10% system. As you likely know, I use the 50-week simple. For this, I like to use the 30 EMA, but it works with all moving averages and in all time frames. Anyway, AGI is a mystery chart follow-up. This one was not a mystery chart because I did mention it after it triggered here. It triggered and before I had a chance to make it a mystery chart in a weekly chart. So the mystery charts, I'd say 99%. Maybe they'll come, maybe a few come from Facebook. Mystery charts are always something that I either recommended directly through a trading service or brought up in Facebook. But I'd say probably 95 to 99% come straight from a trading service. Anyway, this was one I recommended a while back. Nice uptrend. And this is a gold stock. And that's a really persistent uptrend for a gold stock. Notice that the bars tend to stack on top of each other, tends to go up day after day. And you could draw a line through quite a few of them. And then also notice that after this correction, the trend really accelerated higher out of the setup. And that's the ultimate goal, is to catch that parabolic move out of some sort of pullback. So I call this a TKO. It's kind of a TKO over 2 days. A TKO, you have a market make a new high and then it gets slammed, ideally the next day, because that means the most amount of people on the wrong side of the market. Also, notice you have a minor double top. That's a pattern I call a double top knockout, or a DTKO. And that's when you have a tiny little double top, a high surrounded by 3 or 4 at least lower highs, okay, followed by another high, or 2 highs, I should say, surrounded by 3 lower highs in between at least. Anyway, it gives you a little bit of a minor double top. The shorts get excited. They think that that's a little top. Shorts like to get in as soon as possible. They have a bit of an ego. In fact, it's actually a shorting strategy called shorting the parabolics, which I think is a bad strategy, and you can get in a lot of trouble with that. So basically, shorting the parabolics is if a market's going straight up, you short it. Good luck with that. That'll work until it don't. That's one of the few things I can promise. Short it. And some of these guys are putting leveraging their account and putting their entire account into one position. Just crazy stuff. And when it works, they print money. But unfortunately, what if that stock gets halted and opens 10, 20, 30 points higher? You're going to be a hurting pup really quick. And that's one of the cool things about the TKO is sometimes the market will go parabolic, and what's happening is those shorts are getting squeezed out on the way up. And as I preach every week, or most every week, I should say, everything I do has a psychological backing. So technical analysis can be seen as like mumbo jumbo if you're doing some arcane thing or whatever. But if you're being conceptually correct, you're just looking at the market and saying, okay, there's obviously demand for this market. I've got my little pattern. I've got my little setup. It's a clean chart. I think it's worth a shot. Anyway, there's all the parameters down below. Fairly volatile stock, so it took 5 points of risk, which was a fairly high percentage-wise risk, but you adjust your share size down accordingly. And this is based on a hypothetical 100K account, although I do take the trades, and I will show you how I played this one in just a second. So the entry was up there, stop was down here, and again, the IPT was up here. So there's the actual trades, and I'll walk you through those in just 1 second. But plus 400 there on the entry, minus 200, a little bit shy of that IPT, and I'll explain to you why I did that in just 1 second. We talked about it in detail last week, so if you want to take a look at last week's webinar, or you can go to my playlist, Dave Landry's Methodology in Action, because I take the subset of like the actual trades and stuff, and I put that in the Methodology in Action so you can see how it all works. But anyway, I ended up getting out of the remainder 200 on the spill that we had this morning, the debacle. So anyway, if you take where I exited, which was a little shy of that IPT, I was trying to get out a little bit closer to that 31 and change, and then the market came back in by the time I got around to getting out. And part of the reason it sort of came back in is I'm over on Facebook saying, okay, guys, I'm thinking about getting out. Don't split hairs. We're close enough to the profit target. By the time I got out, I should say, I had the market had come back in a little bit, but still not a bad trade. Almost 4 points on the first loaf, 200 shares on that profit-taking loaf, so to speak. That's $784. $1.81 loss on the remainder, and that sucks, to put it mildly. Especially, and you don't want to do this, and it kind of pains me to talk about it, but you don't want to look at where you were, because all trades eventually end badly, right? You can't look at you're losing 6 points on this trade, because overall you made money, of course, provided you use a little discretion on the thing. Now, I don't want to rub salt in anybody's wounds. If you didn't use discretion, that's fine. Mechanically following something like this is a discretionary method, but you can follow it mechanically based on my recommendations, and that's how I track everything. But if you are following it mechanically, if you're new to trading, or if you lack discipline, then by all means get the reps in, and that's another one of those million little things I really want to harp on in upcoming weeks. By the way, I don't know if I said this earlier, I probably want to do a show next week. Got a lot going on. I do have a webinar for Metastock if you're interested in attending that. And all next week, webinars doing an online conference. So I'll put a link down below. Anyway, so overall, 784 on the first loaf. Remember the first loaf on the 100K, you want to try to at least get 1% overall on the account, because we're risking 2%. And then so that's $1,000. Unfortunately, you didn't quite get that $1,000. As I preach, the real money's in the second loaf, not in this particular case, but longer term. Occasionally, you'll catch that huge run, 300%, 400%, 500%. Doesn't happen that often, but every now and then, and sometimes you'll be in these trades for years. Again, doesn't happen that often, but it can. And that's the ultimate goal. And as I've said before, I was told I make it sound too elusive, and it is a little elusive. It doesn't seem like the trends come along often enough, but they come along just often enough to make it all worthwhile. Anyway, so overall in the trade, $422. Again, nothing to write home about. Better than the poke in the eye, I suppose. Keeps you in the business, and then you could say next and move on, and hopefully find some more winners. 422 on 100K. That's about 0.4% over a fairly short period of time. So you can play the annualized game. It's not bad annualized, but this is not our ultimate goal. This is just kind of a survival type of trade, and maybe the next one, maybe the TPR, or what was that? What was the other stock? There was another stock might take off for us. Anyway, there it is down below. So follow mechanically, $624 loss, 0.6 on your account, depending on how you want to look at that. That sucks. A little discretion helps again. And like I said last week, there's a few things, and I'll show them to you in just 1 second. But when that market moves really, really fast over a short period of time, you really need to think, okay, I know I'm not getting that full percent out, but I might need to go ahead and take some profits, because this is a bit of a gift horse type of trade. Now, there's the trades up there. So you can see the trade from this morning. You come in, they had earnings last night, and oh shit, well, Dave, why don't you exit before the earnings? Well, what if they had blown out earnings, or what if they might have blown out earnings, but the market didn't like it, right? The market was expecting more, or whatever the case may be. But if you look at some of those really big winners, those aforementioned huge winners that we held for years, you had 10 or 12 or however many earnings periods over that period of time, and the trade just worked out, and you ride out those earnings, good, bad, or indifferent, via a trailing stop. But anyway, So when you have a gap open, a lot of times you have this panic selling on the open. And we actually could use this open to gap reversal to our advantage. Like if we're trading, let's say you come in and you see a stock that's set up as a pullback, bigger picture, everything looks fantastic, like this trade looked going into it. And the next day you come in and it gaps down. Well, you might look to play an opening range breakout a la Toby Crable, right? And play that gap higher. That's an ogre, open to gap reversal, and that's also a Russian doll because you're trading a pattern within a pattern. That could actually be a really good pattern to trade, especially if you're in a rip-roaring bull market, stock gets whacked, but a lot of people still want to own it, and it turns right back up. In this case, unfortunately, it did not work. You want to let that opening range sort of unfold a little bit, and knowing that if you wait too long and it keeps dropping, you'll lose a lot more than you intended to lose. But you got to give it a little bit of some room. But you have to have an uncle point in mind where you'll get out, no questions asked. And my hope was that it would find its low within the first 30 minutes or so of trading, or ideally first 5 minutes of trading. This is a 5-minute bar. And unfortunately, it did not. So I got out for a bigger loss than if I'd have just gotten out on the open. Well, it happens, and that's the trade-off, and that's probably why they call it trading. There's always a trade-off. Now, just to recap, again, when you're using a little bit of discretion, whether it be like a potential stop situation, okay, or a profit target being neared, you're not throwing caution to the wind. And like I said last week, nobody's perfect in their trading or analysis, unlike the YouTube gurus will lead you to believe, okay? Nobody's perfect. So again, the example that I used last week was we had a stock that went down to $8.99 and our stop was at 9. This was years ago. And it was a little solar stock back when solar was hot, no pun intended. And there was, I try to remember exactly how it was. I think there was no actual trading there. It was just a print right at $8.99, but the market was actually bidding like 9 or higher after that print. So I don't know how that print happened. And it might have been legitimate. It might have been like 100 shares or 200 shares. It was not significant. However, mechanically and technically, it did stop out. And then somebody asked me afterwards, and then of course it took off, went up 300% or whatever the case may be. But somebody asked me after, well, why do you set your stop at $8.99? It's like, well, if I knew that it would only go to 9 and not below 9, then I'd have like some kind of secret or whatever, a holy grail, and I wouldn't share it, right? The bottom line is, as we'll get to in just 1 second, is that I've tried to multi-process, I'm sorry. But the bottom line is, again, I'll get to in a minute, is that we're on a level playing field, and that's a good thing, okay? And the bottom line is, it's not the smartest who wins, because there's a lot of smart people can't make any money in the markets. And Eckhart talks about that quite a bit, and he's got a really good quote. I wish I could think of it exactly, but paraphrasing, I really haven't seen much correlation between intelligence and trading. I know a lot of people who aren't intelligent that do really well. I know a lot of people that are intelligent that can't trade to save their lives. And basically, he's saying average intelligence is more than adequate. And I agree. And that's why I've taken on the name trend following moron. I didn't like it at first. I was very upset and I was down in the dumps because the person who called me that, I had a lot of respect for, and he was looking to do big business with me and all these big projects and stuff, and he got caught up in the markets, and he started fighting the markets, and he didn't like the fact that I was just, and I thought I was just kind of kidding around with him and all by saying, well, it looks like it's going up to me, and I draw my big blue arrows. And anyway, so it ended badly between us. But after getting over my initial stages of grief, whatever, denial and whatever they are, the stages of depression and everything, I got to thinking about it, and there's a couple times where I was trying to buy the bottom or sell the top or whatever the case may be, and I got burned on it. And then I went back to doing my trend following moron stuff, and all of a sudden I'm like, wait a minute, Dave, maybe you are a trend following moron. Anyway, so we talked about this last week. This was the near miss again on the AGI. And you just need to ask yourself a few questions. How far has it gone? How fast has it gone? And how close is it to that IPT? Now, sometimes you'll watch it intraday and it just kind of gets, let's say we're looking at 31, just make the math easy. So it gets to like 29 and 75, and it comes back in a little bit, then it goes to 29.95 and comes back in, and just all day long it keeps bumping up right below that IPT. Well, then obviously you want to take that additional profit target. On the flip side, if you're blessed with a market that blows through it, then throw in a 1 point trailing stop or whatever the case may be, as long as you're 1 point above the IPT, of course. And then that way, at the least, you'll get the IPT, and then you have the possibility of squeezing out a little more. So the reason I'm talking about discretion is a little discretion goes a long ways, and it can really help you trading out. You have to get your discipline first before you can get your discretion. You might want to write that down. Discipline and then discretion. Anyway, so if it happens really quickly, because those type of moves are very hard to sustain, then by all means, feel free to lock and load, and you should lock and load. All right, here's a mystery chart follow-up. This is CCL. This was a short. And down below is a Landry light. Actually, in this case, it's proper order. Sorry. This is bow tie proper order. Bow tie is 10 simple, 20 exponential, and 30 exponential moving average. And when the moving averages are in proper order, it means the 10 is greater than 20, greater than 30, going up. And that is illustrated down below. Now, when the moving averages begin to cross over, it goes from green, because they were in uptrend proper order, to yellow, because they're no longer in uptrend proper order, and then it goes to red once you're in downtrend proper order. Now, as a general statement, if it's green in uptrend proper order, that's a good thing, okay? But you still need to look at the chart. So an illustrator, and I want to come back to these week after next, and whenever we come back to the million little things after this week's. But these illustrators, as I like to call them, because they're not really indicators. They don't indicate anything. Yeah, I saw yesterday somebody's like, I have an indicator that's going to tell you where the market is. I'm like, no, you don't, dang. Anyway, Caddyshack, yeah, that's one of those movies you go back and rewatch, and it's just not that funny. I want to go watch rewatch Naked Gun. I have a feeling it won't be as funny. Airplane's another one of those. But there are a few lines. I speak jive. That was pretty damn good. Anyway, so even though you've got mostly green down here, pay attention to what's happening in the market. Okay, we started making new highs here. That's a good thing, right? And we've got lots of green. All right, so this market's looking pretty good. But then it comes back in. So always pay attention to your net price change. Even though it broke out a little bit here, going back a couple of months, you could see on a net basis, it really hadn't taken off that much. So we know this market's losing steam. Now, we don't do all this analysis until we have the setup, okay? So it's not like I'm going to spend 10 minutes doing this analysis on this chart, although it really only takes a minute. What I'm going to do is I'm going to wait until I have a setup, and then I might do something, okay? And then I'll do all that other analysis. So here we have the bow tie, and that's when the moving averages come together fairly quickly. This is a fairly tight one. Sometimes you get a sloppy one, and it may or may not be worthwhile. There might be another pattern there, but in an ideal world, you want them really, really tight. And also a little tip here, add the 50 simple moving average in. It gives you a good reference point. And when that bow tie intersects that at a sharp angle, okay, when the moving average is hit it at a sharp angle, those tend to be the best. And keep in mind the bow tie is designed to catch more of a gradual type of rollover. So notice here, it's like, it's going up and up and up and up and up and up and maybe not going up anymore. Oh, it's going up a little more. And then the longer term momentum obviously has slowed, and you're beginning to get that inverted cup look. Classical Schwabach, Edwards and McGee, and more modern classics like Pring type of setup. Anyway, I showed Pring my tattoo, and he's I got a picture of him. It was kind of a pinch me moment. It's kind of exciting. And he said, I'm well armed for trading. Anyway, so there's your bow tie. Kind of gives the appearance of a bow tie, obviously. little bit of a pullback. All you need is a 1 bar pullback, ideally a higher high and a higher low. And the entry was here, stop was up here. Now, by the way, I want to cover a few things real quick because these are things I want to get into a little bit more detail, getting back to the million little things. But for instance, one thing is, where would you be wrong in a trade? Where would that trade fail miserably? So in this particular case, if this market starts approaching brand new highs, then maybe it's no longer topping out. Maybe it's just correcting some kind of longer term move and you're done, okay? So at this level here, I realize, okay, this is not too far from all-time highs. If we get short this market and it goes back to here, there's a good chance it might keep on going, and I certainly need to get out the way. But anyway, once you hit that initial profit target, which is this green line here, you bring your stop down to break even, obviously, and then you trail more loosely on the remainder to hopefully capture a longer term trend. Capturing a longer term trend on the short side is way more harder than capturing one on the long side, unless you're blessed with like a big gap down and the stock just dies out over the next 10 years. But anyway, so far we are trailing it lower, see what happens. And on the first loaf, and this was yesterday's mark to market, but on the first loaf, we took partial profits. So it's $1,000 or 1% on a 100K account, 250 shares. And then we let 250 shares ride. And the worst we could do now would be a slight gain on the remainder, because now our stop here, you can see, is well below the entry. So the stop is now at 2150. So worst case scenario, barring overnight gaps, you'll make like 1 3/4 points on the remainder of the trade. Now, we don't want to just make that. We want to make as much as possible, and we want to ride the trend as long as possible. And that's why we position ourselves to stop to break even first at the IPT, and then let that gradually loosen up over time. But anyway, so far so good in the second loaf, and that's the last stock in the portfolio. So if the market makes new highs, goes in, I hope it does. As I tell my people often when we start shorting, I would much rather, I don't want to get stopped on the shorts. Ideally, I like to get initial profit target, but I'd much rather bigger picture, longer term, to put on some shorts and get stopped out of those shorts and have the market go up for a long, long time, because it's much easier to trade the long side than the short side. But as I preach, and I'm kind of a little wound up, but as I preach, you're not gonna get rich on the short side, but the magical thing that it does, so to speak, is it lets you see, or helps you to see, both sides of the market. So if you trade bow ties to the downside and you're in a stock and it bow ties to the downside, then you need to really reevaluate whether or not you should be long that stock. And as I've said 10,000 times at least, not to pick on them, it is what it is. My friends and colleagues who run a lot of money in long only charters, and I don't blame them, because shorting can be a pain in the ass, right? But they tend to be a little bit more glass half full at all times than glass half empty. And we'll come back to that, seeing the market not clearly because you have a position on in just 1 second. But if you play both sides, you tend to see both sides, and that's the biggest help that the short side will give you. Playing the short side is that it really helps you to see both sides of the market. I just want to touch upon the TFM real quick, because I've beat the dead horse on this before. Last week we spent a lot of time talking about how market timing is less about beating the market and more about not letting the market beat you. When you have a V-shaped recovery like we're hopefully having now, although it looks like the market's coming off a little bit today, but let's not get too focused on the micro. Market timing really doesn't work that well, okay? Like the pandemic, for instance, market came right back. But what did happen during the pandemic is the market lost 30% of its value, I think, after the trigger. So there's a peace of mind avoiding those diaper change moments. And diaper change moments, just these big spills that the market has. And if you squint your eyes and notice what's kind of cool, is you can see the 10% line in here. That's 90% of the 50-week closing high. That's a very simple formula right here. 90 would be the percent, so you could 10% below or 90% of the 50-week closing high, and 50 would be the number. But anyway, you can see that the market has made some pretty big spills once it got past that 10%. So that's kind of the designer's intent, is around 10%. You need to think about getting out of the market. And there's no guarantees in trading, but this silly little system would have kept you out of every bear market in history. And I need to figure out I need to find the first video or random thoughts that I published with this system. So the system's been out for a while. But anyway, so we don't know what the type of change is going to be here just yet. So far, it hasn't been that much. Now, the one thing that did happen, which was a bit of a bummer, is that the sell was way down here, and that was much further than I intended. Like I said a minute ago, I only wanted to lose, I don't want to lose anything, but I wanted to lose a maximum of 10%. And because this system was designed around a calendar chart, it inadvertently, as opposed to a rolling chart, technically, because you only get signals on Friday, the market could lose a lot of money in between. And that's something I did not adjust for. The problem is, if I adjusted for that, you'd have to go back and look at how many times the market actually touched the 10% level intra-week, but subsequently recovered, because you'd have to go back and make that sell. But anyway, so far it's kind of going straight back up since the sell after a bit of a dip. Not much, but we'll see how it shapes out. And again, like I showed last week, the only time market timing works, I should say, provided that you have an occasional bear market, and a market, as it will, loses 50% or more of its money. And back in the 30s, obviously, late 20s, the market lost 83% of its money and value. And then you're thinking, well, that was then, this is now. I know I say this all the time. But then obviously you lost 50% twice in the bear markets in 2000, and I think it was 2007, 2008 bear market. The market had a really big drop. Now, these diaper changes in this spreadsheet are actually after the exit, okay? So that's not the total drop. That's the drop after the exit based on the low of the move, which is LOM here. And again, market timing works as long as the market doesn't come right back and sells off fairly hard. A lot of the guys in the gym, the old guys, they're like, well, I'm just going to hold on, we'll see what happens. And that's fine, but occasionally they might lose half of their money, and they might be okay. So far, it looks like we could have a V-shaped recovery in the works. It's like I'm slowly getting, I don't want to use the word bullish, but I'm getting less bearish, because not that the sectors look fantastic, but within the sectors, I'm starting to see some issues begin to bottom out. Anyway, so that was a sell signal on the Qs. We did have a little bit of a diaper change there, but not a huge one, 3%, 14 points. And I was long 100 shares in this one, as I've mentioned before, back from this signal way back in 2023. So that got been $1,400. And again, the idea is to be able to sleep at night. And I say this every week. I know I'm just sick of me saying the same thing, but a good friend of mine was staying with me right around the pandemic times. He spent the night here, and he wasn't sleeping well because he was nearing retirement and the market was imploding. And again, there's like a 30% drop after the system exited during the pandemic, and 30% of your retirement is a lot to lose. Okay, so it's kind of it lets you sleep at night. And yeah, getting out and then getting back in, you probably would have lost about 5% or so, or maybe a little bit more of your portfolio, but you would feel like, okay, well, at least I could still retire, and I'm not going to have to work another 5 or 10 years or however long it takes the market to recover. So market timing only works when the market don't. Might need to flesh that out a little bit. couple things I want to show you this week with the Landry 100. Again, like I've been saying, it's a proof of concept thing, although I did take some very small trades. Of course, the bear market started right as I began to experiment with it at real money. And that tends to happen with this momentum type of thing. You got to be careful of that. But anyway, speculation is still alive and well, even in a bearish market. I don't want to say it's a bear market because technically it's not a bear market yet, but it had looked a little iffy here and there. But anyway, this was, as I say each week, these are all bought at new highs. I don't recommend just rushing out and buying stocks at new highs unless you're going to buy at least 100 of them, okay, or some significant number, and we've yet to figure out what that significant number is. I think Jeff, who might be here today, he statistically has some thoughts on that, something I need to flesh out with him a little bit. But the reason you just don't want to buy a few is because every now and then one will get whacked, which I'll show you in just 1 second. But as far as a proof of concept, you are much better off buying markets that are going up than markets that are going down. So the buy was on this day here. It didn't do a whole lot initially, but it eventually did take off. And so far it's up 187%. Now, this was a couple days ago, the day after this one went into the portfolio. And again, this is not real money. I did take some of these trades on a very small basis. Like that TOI I just showed you, I am long that one from my experiment. I'm also long that one from, it was an honorable mention in last night's service, and I did take the trade. So I am long that one too. It's college fund worthy. I mean, if you got kids, grandkids, college fund, just put everything into that. I'm joking, obviously. But seriously, put everything into it. No, don't do that. Anyway, so this had this huge move, 126% overnight. Okay. So it can happen, right? And that's the ultimate goal, is just have something take off. Unfortunately, so is the risk. So take a look at this one. And ironically, on the same day, this thing imploded 43%. And those were both trades, so to speak, or whatever, that were only in a day or two. So it happens. And that's why if you were to do something like this, you'd want a big portfolio as far as number of stocks. So you're catching some of those 200 and 300% winners. And if you get stopped out on something at some kind of huge loss, then so be it. So a couple of random thoughts. Again, let's just go through these quickly because we talk about them every week. Momentum does end badly or can end badly. All trades eventually end badly, and momentum can end badly. I lost my screen. Okay, here we go. Now, relative strength of the bear market is okay. So we really didn't have enough bear market here, so to speak, to see how that's going to work out. But if you go back and look at some prior presentations when this market was beginning to topple, we had places like drugs, major drugs, which are still kind of hanging in there, and a few other areas, but then they rolled over too. So eventually they find you. So you got to be really careful playing relative strength in the bear market. Now, it's still a great way. I didn't spend too much, or I didn't spend any time on this week, but if you go in and look at the stocks, or maybe even those screenshots, you'll see there's a lot of golds in there. There's some defensive stocks like tobacco. There's some stocks that can be super speculative like biotech and medical. So it's a great way to see where the money is flowing, especially in a bullish type of market. Cash is not trash and treated like an asset class. So this list went down to about 60 something or 70 something not that long ago, but I've actually been able to find stocks to put back into it, even though the market hasn't been fantastic. But I will, if the market were to keep dropping lower and lower and lower, then these stocks would be taken out one by one, and sometimes more than one by one, obviously. And I'd have fewer and fewer stocks if no new stocks are coming in. But it is a really good exercise again. And one thing it's forced me to do is like look at some lower historical volatility stocks, something I'm not crazy about doing, but pay attention to those defensive areas and see what's happening there. And then I don't want to rush out and trade those areas, but that just kind of confirms that, okay, we're in kind of a bearish market where your defensive stocks are doing better than all your go-go stocks, or previously go-go stocks, I should say.